Hi. So here we are doing the vignettes of equity. So out of the 6 readings that we have, right, I've summarized some of those readings and chosen some of the, vignettes. Now, of course, these are not the same as what you have in your Schwezer book. These are a bit different, okay? Because there's no point of repeating the same that you have in your Schwezer book. Now, these are not too easy, not too difficult. They are relatively manageable. Of course, after this, I would recommend you to also try the CFA Institute's case studies or vignettes. Then it will be much easy to approach. So step by step, first you see the Schwezer, then you do this, and then you can do the CFA Institute mocks also. Now, what overall happens is that if you have done the Schwezer notes, you have already covered around 300, 400 questions there. More than not 300, 400 questions. If I would say there are at least so many vignettes, so you've covered sizable amount there. Here, I'm going to cover, for example, in equity itself, I'm going to cover at least 8 to 10 vignettes. So considering all the 10 topics, you will be covering substantial amount of vignettes. So even if you take on an average 5 to 8 vignettes minimum, for each reading you will be covering at least around substantial readings, some substantial vignettes, because you have 42 readings. So even if I take 1 or 2 for each, on an average you will be covering 50 to 60 vignettes. These 50 to 60 vignettes into 5 or 6 questions, sometimes that is additional 300, 400 questions. So sizable thing is already covered, and then you are prepared for the CFA Institute mocks. Correct? So the last point should be the CFA Institute mocks. Right? Perfect. We'll start. Everyone, my screen is visible. Check, 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 confirm. Correct. Everyone, audible, visible, book, pen, calculator. Let's start with the first. Now, see, of course, there are topic-wise strategies which are different, which I'm going to discuss in the class. But one strategy is very common that we've been using not only throughout the syllabus, but also since the beginning when we saw case studies, even during our university or school time, is that instead of wasting time in reading entire case study word by word, it is better to use the approach which I called is the hunting approach. Means basically you look at the questions and try to hunt that information or find out that information in the case study. Okay. Broadly, reading the case study is no harm, but this strategy of first looking at the question and then going to the vignette, that saves your time, and not always, but most of the time it is in the same flow. Okay. So for example, as soon as you see the case study, you should be aware that, okay, this is related to equity or equity valuation. It's a size, a very lengthy case study. So what we will do is that we will just read a brief, and then we'll directly go to the questions, and then we'll read it simultaneously, because anyways, you'll have to read it twice. If you do first read the case study, then do the questions, you'll have to read twice and you'll waste time. Correct? So let's read a brief. Anna is a financial journalist and editor working for Money in the Morning, an online daily journal, okay, aimed at investment industry. She's currently reviewing 3 articles, okay, which staff writers have submitted for publishing. Helen has few concerns with articles which she notes down. Okay, so the first one is about the equity valuation process. Okay, the second is her concerns. Okay, and then there is any third article. No, there is some statement, okay, by the chairman about the approach basically. Okay, let's see. Now, they have asked, why is the introductory paragraph in Article 1 incorrect? So basically, they're asking about the introductory paragraph in Article 1. So I go to Article 1, right? And in that introductory paragraph, that means basically whatever I need related to that question 1 is out here, right? So I actually, of course, in exam, you don't have to write it, but I'm writing it for my purpose. So what is the introductory paragraph saying? Grossman states that if security prices are informationally efficient, there would be no reward for collecting and analyze information. Anything wrong with this, everyone? No, right? Because the intrinsic value will be similar to the market price, isn't it? If this is the case, no investor would collect and analyze information, and market price could not reflect intrinsic value. Market price will be in fact similar to could not reflect intrinsic value, because then there is no point of doing arbitrage or doing investments. Correct? Further works have shown that the easier the intrinsic value is to estimate, the bigger the potential divergence between price and the value. Guys, there is something wrong here, right? They are saying easier the intrinsic value to estimate. In fact, the difficult to estimate, the larger will be the difference, isn't it? So this word easier, it is to determine. See, if it is easier to determine intrinsic value, what will happen? The intrinsic value and market price will be close. So the divergence will not be as high. But if it is difficult to find intrinsic value, if the information is not available, then the divergence will be high. So one thing that is wrong with this statement is the word easier. Now, if you see, they've put the same thing. Most analysts believe at some point intrinsic and market value will converge. Yes, in the long run it will. Nothing wrong. Sorry. Remember, we are looking for something that is incorrect. Incorrect. Okay. Now see this. The harder intrinsic value is to estimate, the greater the potential divergence, right? Correct. But if you look in the statement, they use the term the easier. So this is something that was wrong in the statement, right? They should have used harder, but they use the term easier it is to estimate. Am I correct? So this is something that was mentioned wrong in the statement there, isn't it? Check, check, check. Market cannot constantly be informationally efficient, as that would mean that intrinsic value and market price will be always identical. True. This is fact, right? Market price and intrinsic value are not always same. So they are not always efficient. Am I correct? Everyone understood why B is the answer? Check, check, check. Please confirm. Check, check, check. Okay. Yes. Let's look at the second question. Using suggestion as of an analyst's intrinsic value, which is 1.2 higher than the, what is it in the example for article 1, calculate the valuation error and actual mispricing. Remember the formulas. Remember the formula which we did. Actual mispricing is the difference between the intrinsic value that should be there actually and the actual market price, isn't it? So the actual mispricing is the difference between intrinsic value actual and the current market price. And the valuation error is because of the error committed by the analyst. So it's the difference between intrinsic value that the analyst thinks so, right? It's a difference between the intrinsic value that the analyst thinks and intrinsic value that is actual, right? So it's a difference between two intrinsic values. Intrinsic value that the analyst thinks and intrinsic value which is actual, isn't it? If you add both, what will happen? If you add both, then you will get the mispricing. Mispricing when you add both this and this. Let me show. When I add this, intrinsic value actual disappears, and that's how I get the mispricing. Mispricing is what the analyst thinks intrinsic values and what the actual market price is. So here they have told me that analyst intrinsic value, which is $1.2 higher than that illustrated in example for article 1. So I need to go in the example, assuming an analyst has performed a valuation on security and come up with the following results. Analyst derived intrinsic value is this. Guys, what is this? This is intrinsic value as per the analyst, right? Correct, correct, correct. So this is intrinsic value as per the analyst. Now, the problem is that they said, according to this, the actual intrinsic value is 1.2 higher than what the analyst said. So actual intrinsic value is 1.2 higher, everyone. So yes, can someone tell me what is going to be my valuation error? Valuation error is the difference between both, isn't it? Everyone, the difference between what the analyst assumes and what the actual is, which is what they've already given me. So can I say my valuation error is 1.2, which they've already given me, correct? Now, if the valuation error is 1.2, that means the actual intrinsic value is, they are saying 1.2 higher than what the analyst has given. The analyst has given me the intrinsic value of 25.2. And this value, they are saying suggestion of an analyst intrinsic value, which is 1.2 higher than the actual one. So can I say the actual intrinsic value, is it higher than what the analyst said or lower? Analyst derived is 25.2, which they have mentioned, that this is relatively higher. Analyst's intrinsic value is higher. So can I say the actual one is lower? Am I correct? Right. So 25.2, should I subtract 1.2 or add 1.2? Analyst was higher, so I should subtract, right? So 25.2 minus 1.2, this will give you 24. Correct? Correct. And what is the market price? The market price of the stock is 23.85. That is the actual market price. So when I subtract this 23.85, I will get the answer as 0.15. Everyone, correct? Check. Right, everyone? Okay. In response to Heller's point regarding the limpum discussion in Article 2, so I want to, so here all this information that I had, use it for my question number 2, right? For Article 2, this is going to be question number 3. Okay. What is that they are asking me here? Okay. Which of the following correctly identifies the suggested valuation method? Going concern, liquidation, or orderly liquidation? Yes. Which of the following is correct? So let us see the situation and we will have to identify which is the correct approach. Okay. So let's see. The blanket government ban of its new product line leads to a problem in deciding an appropriate valuation. Okay. There is a government ban because of tariff by Mr. Trump, maybe, right? If the business is not a viable, any business which is not viable, we use liquidation approach, correct? Then any kind of valuation based on free cash flow, perhaps, or perhaps even more outrageously, dividend growth is pointless. True. Assuming that the business is voluntarily winds down over the next year, immediately, then you use the liquidation value, as I believe it should, and gradually sell off its assets. So yes, it is going to take time. It is not immediately going to wrap up. I would suggest that the value of the security be no more than the cash the asset sales would bring in the net of the firm's liability. Heller wants to write to name the suggested valuation method. So which valuation method should we use? Now they have told us going concern. We can't use going concern. Why? Because the company is going to shut down. Correct? Now, there is liquidation and orderly liquidation. Liquidation value when you are right now shutting down immediately. But when you're going to do that over the period, yes, very rightly said by everyone, we are going to use orderly liquidation value. Everyone with me? Check. Clear? Okay. Now, in the toys to you discussion in Article 2. So I will go to Article 2 and toys to you discussion. Where is toys to you discussion? This is where my question number 4 lies. Now, I'm not saying this strategy works all the time, but I'm just telling you that you can use this. And of course, I'm sure many of you must already be using this. A brief review of somewhat fanciful chairman statement and a comparison of summary of income statement of Toys to You Inc. compared to a direct competitor demonstrates a problem in the generic strategy. Okay. Revenue of our company with the competitor. What do you see? Our revenue is falling compared to the competitor and net income is also low, isn't it? Correct? What would be the most appropriate conclusion? Okay, let's see this statement also. I believe that future of toys is a bright one despite the difficulties encountered over a turbulent last 18 months. So therefore, last couple of months situation was bad. Our continued commitment to producing traditional toys, they are planning to be in the traditional business with match our competitors and quality and price will ensure our loyal customer base is maintained. While our cutting edge production technology will maintain our industry leading cost base and deliver superb returns to our investor. So they are planning to be focusing on the cost. Heller would like to add a conclusion regarding the problems with the strategy. Okay, no problem. So what is the conclusion here? First of all, we see a poor revenue and income growth, right? So what would be the most appropriate conclusion? First, the company is attempting a strategy of product differentiation. Is it trying to do a different product? Is it true? Is it doing product differentiation? No, they said they are planning to continue the same, right? So is there a product differentiation? No, correct. Companies attempting a strategy of cost leadership, true, by keeping the prices equal to or lower than its competitor, but appears to failing as margins are lower than the competitors. So, while match our competitors on quality and price. Now it is trying to match. Okay, they are saying it is trying to keep the prices equal or lower. Now, we don't know whether it is lower or equal. We will have to check point number C also. Companies attempting a strategy of cost leadership by producing the lowest cost base, but appears to be failing as margins are lower than its competitors. So we will check the exact words, what they are trying to do. Both the statements are quite similar, right? So our continued commitment to producing traditional toys with which match our competitors on quality and price will ensure a lower customer, while cutting edge production will maintain our industry leading cost base and deliver superb returns. So they are planning to be the lowest cost producer, isn't it? Correct. So between B and C, lowest cost base, of course, their margins are failing. So the only difference between B and C is in this cost leadership by keeping prices equal or lower than its competitors, or the lowest cost base. This is where we have to identify between the B and C. If I go by exact words, which option should I choose, everyone in the class? B or C? Check, 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 check. We will use C because almost everything is common, except that in C, they are using the lowest cost base, not only because of the cost, but also because of the technology. Correct? Which of the following would not be an example of one of Michael Porter's 5 competitive forces applicable to toy? Remember Michael Porter's 5 forces: threat of bargaining power of buyers, suppliers, threat of new entrants. Correct? Then you have what else? You have competition, rivalry amongst the industry, right? So Michael Porter's 5 forces. Let's see. A new chain of toy stores, games, and goodies has opened. This is substitute, isn't it? Threat of substitute. So this is one of the Michael Porter's 5 forces, correct? Toys to Toys biggest supplier as due to unforeseen market condition added premium. This is bargaining power of suppliers. This is also threat. Due to cash flow issues, Toys to you have been forced to halt the marketing and advertising budget compared to the previous year. Now, marketing and advertising budget are substantial, but they are not the Michael Porter's 5 forces. So they are asking which one would not be an example. We would say C. Clear, everyone? Right? Right? From this topic, there is a high chance that they ask you something related to the valuation error. Clear, everyone? Perfect. Anyone, any doubt with relevance to this? Check, 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 check. Okay. Let's move to the core business, that is the dividend discount valuation. My entire area of interest is in the next 3 readings, that is dividend discount valuation, free cash flow, and residual income. Okay. Or market-based approach, sorry. And of course, residual and private also. Dividend discount valuation, we've taken here 2 vignettes considering the size. So let us see the dividend discount valuation. Okay, again, I'll read the brief. Company has just completed several rounds of job interviews, okay, with a valuation group. Okay, and so they are basically discussing about valuation of this company, which is okay. And Nix tries to overwhelm her with financial information of variety of firms, including Turbo, Altman, and Reality. So there is something about Turbo. Okay, where is Altman Constructions, right? Wherever I see, and Reality Production. These are the 3 companies that they are discussing. Okay. Which of the following statement is least accurate? The two-stage dividend discount model is most suitable for analyzing firm that, this is a general question. So it is least likely suited for whom? Sorry, the two-stage model is most suited for analyzing firms, two-stage. So someone who's going through transition and then constant, right? In an industry with low barriers to entry, anyone can enter into this industry. Such an industry is going to be matured, isn't it? Correct? Perfect competition. Anyone can enter in. Correct? Are expected to grow at a normalized rate after a fixed period. Yes, this is a two-stage. Own a patents which will expire and for a very portable product. So after the patent expire, the growth will be different. So amongst the three, B and C definitely are two-stage, isn't it? A, A might be in a different stage. Isn't it, everyone? Correct, correct, correct. Everyone? B and C are definitely two-stage. A is uncertain, right? Now, question number two important. What is the implied required return for reality productions? Now, I look at reality production information. Where is reality production? Yes, reality production, which is currently trades at 30 per share. Dividend is 1.5, but historical dividend growth rate has been stable at 10%. Dividend growth rate is expected to decline linearly over the 6 years to 5%, and then 5% forever. Can someone tell me what type of dividend discount approach will we use here? Yes, amazing, amazing, very nice answer. H model. Why not two stage and why H? Because it is going to decline linearly over 6 years. When they say linearly over 6 years, in that case, my H, which is 6, correct? 6 times over 2, which is going to be 3. So how do I do the valuation in such a case, guys? What is my valuation approach? My valuation is V0. It is D0 over what is the common thing, which we did the shortcut. Remember in the formula notes that we were doing, we did the shortcut in the case of H model. You can also use the H model shortcut, that is KE divided by growth. So we can use the cost of equity divided by the long-term growth, correct? And then in the bracket you can combine, so you can use the bigger formula also. Then we use D0 into the H, which is T over 2, correct? But D0 in cost of equity over growth is cost of equity minus growth is common, so all we have to use is this 1 plus growth rate. Everyone, which growth rate am I going to use here? I'm going to use the long-term growth rate, correct? And then we will also use the H model part, that is plus, I will use H, which is in this case 6 by 2, correct? D0 is already pulled out into the difference between the short-term and the long-term growth rate. So short-term and long-term growth rate. Remember, short-term growth rate is generally higher. This is what my formula will look like. Everyone in the class, correct? The difference between the both, right? Now, the thing is that we are looking for implied KE, means we have to make sure that all of this translates into the price, which is what they've given to me. This becomes $30. So all of this should be equal to 30. Am I correct? Correct, correct, correct. First of all, we will use H mod. So how do I find the 30 year? I have the dividend. Let me put up the valuation here. I will write down. So my V0 again, I will put down. It is D0, correct? Into 1 plus growth rate. So I will write into 1 plus growth rate long term plus H into short term minus long term growth rate. All of this divided by cost of equity minus growth rate. This is going to be my D0. Okay. Long term, short term, and long term. This is what my formula shortcut is. Correct? Now we will put the numbers here. This is for question number 2. correct? We are using the H model. Do we have the numbers here? Yes. What are the numbers that we have here? We have 30 is the price. Current dividend they have given us is 1.5. Short-term growth rate, dividend growth rate has been stable, 10%. It is expected to decline linearly to 5% over 6 years. So we have the short-term and long-term growth rate, 10 and 5%. Okay, so the current dividend is 1.5. This all should result into 30, 1.5 over the cost of equity. What is my cost of equity here? My cost of equity, instructs with current EPS and a required return of 18%. Is that 18%? 18%, 18%. What is going to be my cost of equity? Oh, that's what we are looking for. I'm so sorry. We are looking at implied required return. Cost of equity is what we are looking at. Sorry. So this divided by KE minus the long-term growth rate. The long-term growth rate is 5%, right? Into 1 plus long-term growth rate, that is 1.05, plus H is now 6 divided by 2, that is 3, into the difference between 10% and 5%. Correct? Right. Now, what we will do is that we will use their inputs, but there is some common sense here. Okay, let me first solve this, or you can actually use some common sense also there. See, we know that the cost of equity can never be lower than the growth rate. It has to be higher, right? So the short-term growth rate has been 10%. So definitely it is all higher. So it is 12.5, 11 or 11.75. We will have to make sure that whichever we use, the present value of that brings us 30, correct? So what we can do is that we can solve all the numerator, and wait for the denominator, and we can do trial and error. So basically, I will solve the entire numerator. I will put here 6 divided by 2, that is 3 into 5%, correct? Plus 1.05. I get 1.2 into 1.5. This is 1.8. Am I correct? 1.8 into K minus 5%. Now I have three choices. I have to see which of the choice gives me 30. So what are the three choices? One is 12.5. So 12.5 minus 5 is 7.5%. So 1.8 divided by 7.5%, that gives me 24. So I'll have to reduce it to 11. So 11 minus 5 is 6%. So 1.8 divided by 6%, that exactly gives me 30. So this has to be 11% for me to get 30. Everyone got it? Check, 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 check. Right? Interesting. Now, see, in the formula, when we were doing it, they told us how to reverse the formula. You don't have to change the formula. Just do the trial and error. Easy. Clear, 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 everyone? Check, check, check. Got it? Anyone, any doubt with this? Now, based on its current market value, what is the implied long-term sustainable growth rate of Turbo Financial Advisors? So Turbo, we have to look at the long-term growth rate of Turbo. We use H model for the company called, what was the company called? Reality. Now we don't know what model should we use for Turbo. We will use see the information, and we will have to see which model is applicable. Okay, they will not tell us. So Turbo, this is the information of Turbo. Okay, impressive earnings growth. Earnings per share have grown at a compounded rate of 19% over the 6 years, pushing earnings to 10 in the year just ended. So I have current year earnings as 10. He considers the growth rate very high for a firm's cost of equity of 14%. So I have cost of equity of 14%. Okay. And a weighted average cost, I don't require weighted average cost when I'm valuing the cost of equity. Am I correct? He's especially impressed that the firm can achieve these growth rate while still maintaining a constant dividend payout of 40%. So my dividend payout, which is going to be 40% of 10, that is going to be 4, which he expects to continue indefinitely, guys, indefinitely. And the market value is given 58.18. Correct? Alex considers strong buy, believes that Turbo will have one more year or strong earnings growth with EPS rising by 20% in the coming year. He then expects EPS to fall 5 percentage point for per year for each of the following 2 years. So 20% it will grow for the coming years, and then 5% it will fall and achieve a long-term sustainable growth rate of 5% beginning the year 4. Beginning the year 4 means end of the year 3. Am I correct? So this is where I require a timeline. Okay, timeline is very crucial in this case. So what I'll do is that I will plot a timeline for question number 3. Everyone, correct? So see, first of all, which model will I use? Okay, a multi-stage model, isn't it? They have given me current dividend and they are expecting the payout ratio is same. So instead of earnings, you can simply take the dividend. The current dividend is 4 in the current year, 1, 2, 3, and let me see. In the next year, it is expected to grow at what percentage? We discussed it is expected to grow at 20% in the coming year and then fall 5 percentage per year for the next 2 years. So 20 percentage, it will grow at 20 percentage. Now what I will do is that 4 into 1.2, store 1. Can you store 1? 4.8. This will be 4.8. Then this was 20 percentage, right? But now it will be 15 percentage. So into 1.15. So this is going to be 5.52. This is 15 percentage and then 10 percentage. So into 1.1, this is going to be 6.07, store 3. So I have recall 1, recall 2, recall 3. Then they said beginning 4th year means at the end of the 3rd year, it is going to be now 5% indefinitely. So guys, can I say my terminal year is 3rd year because now it will grow indefinitely at 5% from the next year. So 3rd year is my terminal year. For terminal year P3, we based on D4. So I already have my D3, correct? Into 1.05. But guys, actually it is not 5%. They have asked us what is going to be the long-term growth rate. Actually, they gave us that the growth rate that they are expecting remain at 5% indefinitely. But that is for my mistake for reality. For year, the long-term sustainable growth rate of 5% beginning year 4, they have mentioned. But in the question, they asked me what is the implied long-term sustainable growth rate. So even though they have given me 5%, I will not take that 5% because I have to find what is the growth rate which gets me this price, right? So even though they've given me 5%, we will not take that. We will have to find what is the long-term growth rate. So we will use 1 plus growth, the missing, over the cost of equity, and the cost of equity we already got is what's 14%. They've already provided us. So it will be 0.14 minus the missing growth rate. Now I have all the dividends. So I have in my C01, C02, C03, C01, C02, C03, C01. I have in my discounting rate is also given to me, right? My C01 is going to be 4.8 already in the store one, 5.52. This C03 is actually 6.07 plus the terminal value. Understood, everyone? Correct? This discounted at 14 percentage should give me the present value, which is based on the market price. What is the market price they have given me for turbo market value of 55.18. So 55.18. Now we have to look at what is that growth rate which will give me this value. Remember, the long-term growth rate cannot be more than 14%, isn't it? So all of the numbers are below 14%. No, the first two only. So either it is 4% or it is 0.3%. Am I correct? It cannot be C because K minus G cannot be negative. So either it is 4 or 0.3%. We'll first try trial and error with 4%. Let's say the long-term growth rate assume is 4%. So if it is 4%, I have D3 in my calculator, 6.07 into 1.04 divided by 14 minus 4 is 10%. So that is 0.1. I get 63.15. I store 4. This is going to be store 4. So this is going to be now 63.15 rounded off. I don't worry about rounding off because I am using the store function. Correct? Now you go to the cash flow second clear. Your C01 will be recall CF0, skip CF0, nothing in CF0. C01 recall 1, enter. C02 recall 2, enter. But guys, C03 will have two values. Recall 3 plus recall 4 equal to, it should be 69.22. In your C03, it should be 69.22. Enter, press NPV, your discounting rate is 14. Enter, compute NPV, you should get 55.18. Are you getting this? Check, check, check. So we already got in the first case itself. Check, check, check. Everyone. Timeline equation calculation, our process. Correct? Perfect. Got it, everyone? Right. So that, what is the price? What is the long-term growth rate that gives me this price? It is 4%. Very interesting. Okay. Which model did we use here? We use multi-stage model. Correct? Dividend discount model. Okay. Next, what is the present value of Altman's future investment opportunities as a percentage of the market price? Can someone tell me what does this mean? Future investment opportunity as a percentage of market price. What exactly are they talking about? They are talking about present value of growth opportunity. Yes. Present value of growth opportunity. This is derived from V0. Intrinsic value is made up of two things: earnings perpetual and PVGO. So if we have the price, Altman's price is already here. So this is going to be my information related to question number 4. Altman's price trading at 22, EPS is 2.5 and required return is 18%. So 22, required return is 18% and EPS is 2.5. So the balance is my PVGO. So 2.5 divided by 18%, correct, minus 22, I will get 8.11. Are you getting this? Check, 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 check. Everyone. Easy, easy. But identifying what exactly they're trying to say is an important thing. Clicking that you have to do the PVGO, present value of growth opportunity, that is crucial. Rest, the calculation is manageable. Got it? Everyone? Clear? Yes. Okay. Very interesting. It covered so many different angles, right? Let's do a second case study related to the dividend valuation approach. This is a slightly lengthier one, but my expectation is in real exam, when things are lengthier, they are not lengthier when it comes to the information. Okay. For example, in the first case, they are asking us, using the Gordon's growth model, what is the equity risk premium? What is equity risk premium? Equity risk premium is cost of equity minus RF. So this is the first thing we are going to use, equity risk premium of which company. So that's where we'll have to start using the information. So equity risk premium using Gordon's growth. So here the cost of equity we are going to use using the Gordon's growth, correct? So for this, we will have to check out all the information that we have from the start till the end. All we require is the cost of equity using Gordon's growth. And when I say Gordon's growth, using Gordon's growth, it is actually dividend yield plus plus the growth rate, isn't it? So cost of equity D1 over P0 plus G. These are the cost of equity components. From this, I have to subtract the risk-free rate. Then I get the equity risk premium. So dividend yield, ideally, if you look at all the information, you will have to read all the information and you'll have to hunt. But just because I've gone through the case study, I can tell you the information is here. 1 year forecasted dividend yield on the market index. Now, this is going to be my forecasted dividend yield already. And long-term earnings growth, should I take short-term government bill rate, medium-term what? I have the long-term earnings growth rate. So I already have both the component. This is 1.75 plus 5.25 minus risk-free. Which risk-free should I take? Should I take the short-term government bill rate, medium-term or long-term? Which risk-free generally we take, guys? Short-term, long-term or medium-term? We prefer long-term government bond as the risk-free, isn't it, everyone? Check, check, check. So I will subtract 4.25 percentage as the risk-free to find what is going to be the equity risk premium. Am I correct? 1.75 plus 5.25 minus 4.25. Everything is in percentage. I just forgot to press percentage here. Your answer will be 2.75 percentage. Correct. So I got my question number 1 related information from here. Are you getting this? Check, 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 check. Equity risk premium using Gordon's growth approach. Remember, in Gordon's growth, how do you find the cost of equity? It is D1 over P0 plus G. D1 over P0 is expected dividend yield plus the growth. We just rearrange the Gordon's growth. From price, we find the implied cost of equity. Clear, everyone? Davidson needs to determine if the shares of Wellborn are currently undervalued or overvalued in the market relative to the shares fundamental value. The estimated fair value using a 2-period dividend discount model. So we are looking for a company Wellborn. Wellborn's information is here. We have to find whether it is under or overvalued. Okay. Current price is given for comparison, and then they have given us dividend to be received next year, then the year, and price expected. Okay, so 2 years dividend and price is already provided to us. Return on equity is provided to us. So two-stage dividend model, very easy. Can we find out the price, everyone in the class? What is going to be my V0? I have dividend in first year plus dividend and price and the discounting rate, which is 9.5. You can use the cash flow function also. So in the cash flow function, you can use 1.45 as C01, 1.45 as C01, and in C02, you will use two things. You will use the dividend 1.25 and 27.5. 1.25 plus 27.5. You can use the cash flow function. And then when it comes to the discounting rate, you can use 9.5. I am writing it manually here, 1.095, 1.095 square. Remember, it's not Gordon's growth. You can use whichever, you can use a cash flow function also. You will get the present value. Let me know the present value, everyone. 5 times 1.45 store 1.095 square inverse into 25 plus 27.5. 23 plus this, I get 25.3 approximately. Correct? 25.33, which is nothing but your answer C. Check, 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 check. Precisely, you'll get 25.286 or something. Got it, everyone? Easy two-stage model. As part of our analysis, Davidson needs to calculate return on equity for both potential investments. What is last year's ROE for Samsung shares? So I have to go for Samsung and find the ROE. This is what is going to be my question number 3. ROE. Guys, ROE is simply net income over total equity, isn't it? Isn't it? Do you have net income? Yes. Do you have total equity? Yes. Simply do that. So it is 5.7 million divided by 60 million. So my ROE is going to be 5.7 divided by 60. Let me find what is the ROE. 5.7 divided by 60. It is 9.5 percentage. Are you getting 9.5? Check, 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 check. Everyone, 9.5 manageable, easy. Davidson determines that over the past years, Samsung has maintained an average net profit margin of 8%, asset turnover of 1.6, and leverage ratio of 1.39. That is basically, they are giving me a DuPont ROE. What is my DuPont ROE, everyone? My DuPont ROE is net margin, everyone, 8% into asset turnover into 1.39, the leverage ratio. This is your three-way DuPont ROE, correct? She continues to distribute 35% of its earnings as dividend. So payout ratio is 35%. They are asking for sustainable growth rate. I know sustainable growth rate is retention into ROE. So my retention, this is what is going to be my ROE times this with my retention ratio. If the payout ratio is 35, retention is going to be 65. Let's calculate this. So 8% into 1.6 into 1.39 into 0.65, you will get 11.56 percentage. Are you getting this? Which is roughly C. Check, 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 check. Everyone, easy, correct? See, so many information were not even needed. All of this, I'm not saying it is always the case, but I'm just giving you a scenario that, of course, I don't recommend you to ignore them, but sometimes it's not needed. As simple as that. Clear, everyone? Dividend discount valuation. All set. Check, 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 check. Perfect. Okay. Okay. So after finishing the first two readings, now we move to the free cash flow. Free cash flow, majorly you will be asked in exam, FCFF, FCFE derivation, and the value of firm. Very simple questions in exam, not so much complication at all, right? Unlike, I was just discussing with the students that unlike what the CFA level 2 curriculum looks like, when you go to solving the questions, it's pretty much simpler. It's not that complicated. Okay. So under this vignette, as per our strategy, what we do, we directly first go to the question and see what is asked. So that saves our time, right? So given in the assumptions contained in scenario one under this, correct? They have asked us the value of the firm. In this case, in scenario number two, also value of the firm. So basically scenario one and two, we need to calculate value of the firm for which we require FCFF. However, we'll have to see whether Gordon's growth, the constant growth model is required, multi-stage, what exactly is required, right? So let's go with the first thing. We are going to do in scenario number one, value of the firm. Scenario number one, analyst has prepared two scenarios for Snyder. Tax rate, VAT is provided to me. Constant growth in free cash flow to the firm is provided to me, and growth is given to me. Now, since it's a single stage information, there is no multi-stage information. Now, here, if I want to find the value of the firm, my formula will be FCFF next year, correct? That is FCFF current year into 1 plus growth rate. Am I correct? The constant growth rate model divided by, instead of KE, I will now put WAC. Why? Because it is the entire firm, right? So here my value of firm will be the current free cash flow. What is the current free cash flow? Year zero. Current free cash flow is 30 million into the growth in the free cash flow is 3%. Pretty much easy. No complicated at all. 1.03, correct? That is the growth rate. 30 into 1.03 divided by WAC minus growth, that is 9%. So 12 minus 3, I will put 9%. Very simple, right? 30 into 1.03 divided by 9%. You should get 343.33, which they've rounded it off to 343 million. Easy. This is the value of the company in first part, right? Very easy. Next, Value of the firm in the second scenario. Now, in the second scenario, we have multi-stage information. So in second scenario, we have tax rate. We have been provided with EBIT. Got it? See, free cash flow, we have discussed that you can derive from multiple angles. Multiple angles you can derive from free cash flow, from net income, then from EBIT, from EBITDA, as well as from operating cash flow, correct? These are the multiple angles, right? So here we have been provided with EBIT, CapEx, and depreciation, and will grow at 20% for the next 3 years. And after 3 years, if you notice, they have probably told you that CapEx and depreciation will offset each other, correct? WACC is provided to me and target debt ratio. When debt ratio is the case, we will apply which formula? The one with target debt ratio. But target debt ratio, is that the formula we require for valuing the firm? Is that the formula that we require for valuing the firm? Target debt ratio information is only needed when you are valuing equity. We don't require it for valuing the firm. So all this information is unnecessary. We don't need it. What we need is to value the firm through EBIT. We need this part through EBIT, correct? So we need EBIT 1 minus T and then CapEx and depreciation. So fixed capital and depreciation both are connected, right? So what I will do is that I will rearrange now the formula. See this. So my FCFF will be EBIT 1 minus T. You need to subtract taxes. See, normally what we do, minus fixed capital plus depreciation, correct? But if you carefully see, I will write it down here, minus fixed capital, that is CapEx, correct? Plus depreciation we do, right? Plus depreciation, right? However, notice what I do here. What if I put these into bracket? If I put this into the bracket, then it will be fixed capital minus depreciation, isn't it? That's net capex. That's net capex. Understood the adjustment? Clear, clear, clear. Right? And then what else is left? What else is left? EBIT 1 minus T minus fixed capital minus depreciation, and then one thing remains, that is changes in working capital. So I will subtract that working capital investments. Clear, everyone? Understood? So now putting up all those information, my FCFF EBIT is provided to me, but I don't know whether this EBIT is with tax or without tax. Actually, they have just told EBIT. What we need is EBIT 1 minus T. So they have said here EBIT, CapEx, depreciation, okay. After 3 years, EBIT will grow at 20% and CapEx and depreciation, okay. They've provided me EBIT. Do I require EBIT? Or I require EBIT 1 minus T. Remember, we require EBIT 1 minus T. So guys, your tax rate is, where is my tax rate? My tax rate is provided to me, market value of cost, shares. My tax rate is, where is my tax rate? EBIT, depreciation. Yeah, tax rate is 40%. So whatever is your EBIT, you need to multiply that with 1 minus tax rate. That is, you need to multiply that with 0.6. So just confirming. Now see, they have already provided me FCFF, right? However, I need to check whether it is EBIT 1 minus T adjusted or not. So what I would recommend you is, can you put 54 into 0.6? That will give you 32.4, right? Minus capex plus depreciation also you can do. So minus 25.9, sorry, minus 21.6 plus depreciation 14.4 minus changes in working capital. That will give you 18.9. Did you notice that? So even though they've mentioned EBIT, they've actually adjusted for 1 minus T. Did you notice that, everyone? Correct, correct, correct. So the reason that I showed you the formula and all is just to confirm that they have provided me EBIT, but when it comes to the calculation, they've taken care about all this thing. Got it, everyone? Right? So I already have my FCFF. I don't have to worry about my future FCFF. So my first year FCFF 18.9 plus second year FCFF is 23.64 plus 29.09. And they said me something that after 3 years, the growth, EBIT growth will be 2% after 3 years. Till 3 year, it is, they are saying that it will grow at 20%. Now that means I require the terminal value, isn't it? After 3 years. So guys, how do we calculate the terminal value P3? It's based on D4. Here I have FCFF. So fourth year FCFF, they've already given me 40.62 divided by WACC minus the growth. Here the growth rate is 2%. What is the WACC here? 12. So 12 minus 2 will be, guys, 10%. Isn't it, everyone? So basically, you will have first year cash flow, second year free cash flow, third year free cash flow, and terminal value, which is 40.62 divided by 10%, that is 406.2. Correct? Everyone in the class? Check, check, check. This, and this. This will be your C01, C02, C03. You will combine both. Discount it to the present value, add the WACC. What is my WACC? My WACC is 12%. So you will do I by Y 12 year and you should get the answer. Let's go to the cash flow function. Cash flow second clear. My C01 will be 18.9. Enter. C02 has to be 23.64. Enter. C03 will have two values, right? 29.09 plus the terminal value 406.2 equal to, enter. My NPV discounting rate is 12. Enter. Compute. You should get 345.55 roughly, isn't it? The closest is 346. Are you with me, everyone? Got it? Great. Next, they're asking me cost of equity. Cost of equity. Now, in order to calculate the cost of equity, we have been provided with WACC. Okay. We also have cost of debt. We have the market value of debt. Clear? We have shares outstanding and we have the current market price. Do we have the current market price? Do we have the current market price? Estimated market value of debt is that what we have. We have the market value of the firm. So we can also find the market value of equity. And they have provided us with cost of debt and tax rate. So I have 1 minus T, correct? Now, in order to find the cost of equity, we can do the reverse calculation using the WACC. So what is the formula normally? WACC is cost of debt 1 minus T into weight of debt plus cost of equity into weight of equity, correct? Now, here we already have the WACC, which is 12%. Cost of debt is 5% into 1 minus T, while tax rate is 40%. Now, before I go with the weights, what I don't have is cost of equity. This is what I'm looking for. But what about the weights? What about the weights? Do we have the weights? Do we have the weights? Do we have the weight? We have your market value of debt is 35 million. Everyone, what about the weight of equity, weight of debt? Now, there is something interesting. How do I find this? Now, many students struggle to understand, okay, how do I exactly know what is my total value? So debt, the market value of the debt is 35 million. Is there any other information through which I can find out what is basically my market value of the company? Market value of the company. See, you have earnings before tax, depreciation, EBIT, capex, WACC, target debt ratio. What does target debt ratio mean? That out of the entire capital, your debt is 10%. So if your debt is 10%, which is 35 million, correct? So how much is total target debt ratio? Debt is over total equity, total capital or total assets. So what is going to be my total capital, guys? My total capital is 35, which is simply 10%. So my total capital is 350, out of which 10% is debt. Remaining is equity. So even if you don't do all this calculation, you should know that debt is how much? 10 percentage, and equity is the balance. Clear? Reverse calculate, you will get the cost of equity. So of course, without saying, you should know that cost of debt is lower and cost of equity is higher. Understood? And the weighted average is WACC, right? So it definitely, even without calculation, of course, you will do the calculation and get the answer, but you should know it should be higher than 5 and lower than 12. Higher than 5 and lower than 12 is only one answer, A. So without calculation also, you can actually make out that cost of WACC is between KE and cost of debt, right? So it has to be higher than 5 and lower than cost of equity. Understood. So I have a WACC 12. So it is between both. I'll repeat this question you can do without calculation also. Right? Next, market value of Snydering stock. Guys, we already got what was the value of market value of debt. They provided us with market value of debt, debt 35, which is 10 percentage, right? 35 million, which is 10 percentage. So I told you that the market value of the entire company or the firm is 350, correct? 90% was the value of the equity, right? So they're asking me what is the market value of equity, company's stock, right? So what is going to be my market value of equity? My value of equity will be 350 minus 35, that is 315 million, divided by number of shares. That will give me value of each equity. How many number of shares do I have here? Shares outstanding 20 million. So divide this by 20. That should be your answer. 315 divided by 20. That is 15.75. Correct. Everyone in the class? Understood? 15.75. Check, check, check. Very good. Got it. Let's do the next question. The next case study where you have been given this tire company's information. The firm's working capital needs are negligible. Okay, okay. What is that that they've asked me? The firm's earnings growth rate. Guys, how do I find the growth rate? What is the normal formula of growth rate? Sustainable growth rate generally is retention ratio into ROE. This is our primary formula of growth rate, right? Let us see, do we have that information directly? Retention, I have the earnings and dividend, so that will give me the payout ratio. So what is going to be my payout ratio? 120 divided by earnings 600. My payout ratio is 20%. So guys, my retention ratio has to be 80 percentage, isn't it? Everyone, very good, right? What about my ROE? ROE. For ROE, you require earnings, that is net income, and total equity, which they have said 6 billion, which is also the market value, isn't it? So 600 million divided by 6 billion, that is 10 percentage, right? Isn't it? So my ROE is 10 percentage. So basically, my sustainable growth rate has to be 8 percentage. Clear? Everyone? Easy? Companies next year's forecasted FCFE. Now, in this case, they are asking me next year's FCFE. So I will have to check first which type of a ratio or which type of calculation is applicable, which type of formula is applicable. Okay. So here I have interest expense, okay, tax rate, depreciation, capital spending, total assets, debt, target debt ratio is there. So now I will use the target debt ratio formula. So what is my target debt ratio formula? I require net income minus 1 minus debt ratio into fixed capital minus depreciation minus 1 minus debt ratio into working capital. This is what I need, correct? So where's my net income? My net income we just calculated is 600 million, right? 600 million, everyone. That's going to be my net income. Now, first of all, is it for the next year? Yes, because all this is forecast. So this is already for the next year. If not, this was all for current year. So all this is already for the next year because this all is forecast. So 600 minus, what is my debt ratio? Target debt ratio is 40. So 1 minus debt ratio is 60%. I'll write down 0.6 minus 0.6. Now I need fixed capital less depreciation. So my capex is 800, depreciation is 500. So I can say my fixed capital less depreciation or net capex is going to be 300 million. So into 300 million. And working capital, they said here that there is perhaps no requirement of working capital, isn't it? Working capital requirement is not there, so I don't need that component also. Correct? So 600 minus 180. My answer will be 420 million. That's going to be my FCFE. Correct, everyone? 420 million. Easy. Next. The total market value of equities given to me 6 billion and the growth rate is 8 and the cost of equity based on the stable growth rate of FCFE. Now, cost of equity based on this is D1 over P0 plus G, right? However, here I have been given the value of equity. So what normally we do is that in order to calculate value of equity, we require FCFE forecasted over the cost of equity minus growth. Now here they've given me growth. I have the FCFE already from the previous case and I have the value of the company's, the total value of the company, right? So what is my value of the company? 6 billion, that is 6,000 million. I have the next year FCFE already forecasted from the top 420 million over KE minus growth rate. Basically, you are looking for implied KE, right? So you can find out that, of course, the KE has to be greater than 8. So it has to be either 15 or 14. You can do trial and error. 15 minus 8 is 7%. So 420 divided by 7%, I get 6,000 directly in the first go itself. If not, you can go for the next one, right? So KE, you can do what? Trial and error. Clear? Easy? P, got it? Next, beta of the company is provided, risk-free rate is provided, market risk premium, WAC. I have to calculate WAC. First, I will calculate the cost of equity, which is risk premium, RF plus risk premium, 10 into this. So 0.1 or 10% into 1.056 plus 5. My cost of equity is 15.56. Cost of debt, I'm going to calculate WAC. So my cost of debt. Do I have information related to debt? Yes, tax rate I have, correct. Interest expense I have is 400 million and the debt is 4 billion. That will give me my cost of debt, isn't it? So I can basically find my cost of debt is 400 divided by 4 is 10%. And tax rate is 40%. So in order to calculate WAC, I need after tax cost of debt. So 10% into 1 minus tax rate. 10% into 1 minus 0.4. Cost of equity is 15.56%. And now what I require is the weight. Clear? For the weight, I have the market value and book value weights as this. This will provide me the weight, right? So I have basically 4 billion of debt, 6 billion of equity. So basically total is 10 billion. So debt is 40%. Easy. 4 out of 10 is 40% and this is 60%. So 10 into 4, 6 into 0.4, store 1 and 15.56 into 0.6 plus equal 1. You'll get 11.736 roughly, isn't it? 736, which is nothing but C, closest. Got it? Right? Okay, so these two case studies where you cover all the angle, FCFA, FCFE, cost of equity, risk premium, everything, right? So to be honest enough, this one page, it covers most of your formulas. Now we go to market-based valuations. Okay. I have got a question. Yeah. Can we use target debt ratio directly here in this case? Target debt ratio? Target debt ratio, yes. In this case, see, in this case, it is matching because what is my target debt ratio here? They provided me the target debt ratio, which we used here as point. Target debt ratio is 40%, right? Where is it? Where is it? Yeah, target debt ratio. Yeah, is provided to us. Okay, so in this case, we can perhaps use. Now, actually, there is a, if you remember from your level one, what should we do about weights? Number one, if possible, you should take market value of debt and equity. Now, market value of debt and equity does not always match the target. So if you have the target, you can take the target if they instruct you. If not, market value. Now, in this case, they both are same, but that's not always the case. That's not always the case. So yes, because the target debt ratio is what companies have hypothetical. This is what they want to achieve. But the equities are so volatile that the market value keeps on fluctuating. So there is a possibility that they both won't match, right? So conclusion, you can use directly target debt ratio. Yes. In this case, it's both matching. If not, you have anyways no choice. You have to go for market value. Rarely we use book value. Book value is the last option. We don't use book value. Got it? Yes. Now moving towards market-based valuation. In this market-based valuation, it's the topic has basically sizable portion in your syllabus. So market-based valuation, FCFF, you can also expect in exam both to be combined together. That is also quite possible. Okay. So let's see the market-based valuation information. We have enough of information now. Of course, when the information is too much, there is no point of going into all this information and reading it. There is a high chance that they might want you to go step by step. Okay, it is possible, not always, but let's see. Calculate the FCFE during 2009 using the data extracted from the 2009 account. So we are looking for FCFE. Now, in order to find FCFE for which company? So we look at some basic information in order to understand where is exactly is the FCFE information, right? Remember, we are looking for FCFE. So at the end of 2009, CFA is writing a report to help advise on potential corporate takeovers. Elliott Inc. is up for sale. So that's my target company, right? So I'll just write down for my reference. This is what my target company is, which we are planning to acquire. Okay. You know why? Because when I was a student, I used to get confused between what's company's name, what's a person's name. It sounds so confusing because English is not our first language, most of us. So sometimes, in a hurry, I used to wonder, oh, Elliot is a person, right? No, no. Then I realized Elliot Inc. It's a company. Pedroia's client is considering buying 100% share capital. Okay, so you're going to take over the entire company. So you will prefer to use free cash flow model because you are going to be the controlling stakeholder. It's decided to include two free cash flow valuations, okay, an extract of the most recent cash flow statement, which he intends to use as a base of free cash flow. Okay, so here we've been given the cash flow statement of the recent year for which I have operating cash flow. Now, then this is my current year 29, right? End of the period, right? And then I have 28 and 2009 financial statements. Basically, these are my balance sheet extracts. Got it? Okay. Now, there have been no sales or impairment of fixed assets, okay? And the net borrowing is provided to me is 14 million. Now, we were looking for free cash flow, but I just missed out on which free cash flow. We were looking for FCFE during 2009. So guys, in order to find your FCFE, okay, Which formula should I look for? They have provided me with CFO, isn't it? So we use the CFO related formula. What is the CFO related formula for FCFE? See, CFO and fixed capital investment is commonly deducted under both FCFF and FCFE. This part is similar, but if they say FCFE, you also have to adjust for net borrowings. Am I correct? Everyone with me? Check, 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 check. So I have my CFO as 130 minus my fixed capital and plus net borrowing. So my net borrowing, they have already told me, is 14 billion. Fixed capital investment for the current year. How do I get for the current year? See, I have last 2 years data. This was 270 and this is 320. Now, ideally, the difference between these two, since there is no impairment or any other adjustment, can I say the only difference is due to purchase? So my fixed capital investment is going to be 50, the difference between both, right? So that if you subtract, that will give you your FCFE, 130 minus 50 plus 14. 94 is going to be my FCFE. Everyone with me? Understood? Yes, very good. So my answer will be 94. Correct, correct. The growth assumption used in calculating the best case scenario valuation are most suitable if, first of all, where is the best case scenario? Best case scenario. I will look for the best case scenario. Is there a best case scenario? Something like this. Have they mentioned something like best case scenario? Oh, yeah. See, it's in the flow itself. For his first valuation, this guy will make simple assumption that the free cash flow to equity will grow at 5% per annum indefinitely. Understood? 5% per annum indefinitely, right? And then in order to reach the resulting value will be labeled as best case scenario. Now, when they are going to use it, in what case and why will you think that this guy is going to use an indefinite growth rate or constant growth rate? Do you value a constant growth rate for startup companies or mature companies? Which type of companies you use a constant growth rate? You use it for mature companies, right? Correct? Okay. So see here, since he's going to use a constant growth rate, so the valuation are more suitable if Elliott has a stable RM in a mature industry with a required return of 4%. Stable RM. Now, what is RM here, guys? What is stable RM? What is the RM here? What is RM? Stable? Yes. Anyone? What is RM? So the growth assumption in calculating best case scenario valuation are most suitable if Elliott is a stable RM. Anyone? What is RM here? Stable RM. What exactly are they trying to say? Stable RM in a mature industry with the required. So first of all, it's a mature industry or infant industry. We know it's a mature industry, correct? Now here they have point out one important thing is that the return on equity is 4%, 14 and 14. Okay. Now, first of all, it's not an infant industry. So the choice is between A and B. Now, in this case, they are asking me the growth assumption used in calculating his best case scenarios are most suitable. So, do we know what is the growth assumption that they've considered there? Let's see what is the growth assumption. They have said that the growth assumption is 5%. So, here, if the growth in free cash flow is assumed to be 5%, if my growth is 5%, guys, you know the assumption of Gordon's growth. Will the cost of equity here the cost of equity, basically the valuation of most suitable if stable RM in a mature industry with a required return, stable return, correct? With a required return of 4%, guys, will the KE be less than G? No, KE has to be greater than G. So the answer is B. B, 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 B. Everyone understanding why the answer is B, 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 B? Yes, got it. Check, check, check. No? Why the answer is B? See, the growth rate is 5%. So the cost of equity has to be greater than 5%, right? Clear? Yes. Calculate the value of equity to its nearest 1 million using an FCFE model and the cash flow assumption that he uses in his free cash flow valuation using forecasted cash flow valuation. All this complicated thing, basically we are looking for value of equity using free cash flow. Okay, we have to round it off. So we use this information. Elliot will over the next 5 years and also intends to use this forecast. Okay, which we'll label as, okay, fine, this. The free cash flow forecasts have been provided to us 2010, 11, 12, and 13, next 4 years. He will discount the free cash flow to at cost of equity of 12%. So 12% will be our K, correct? We have 4 years of FCFE, but remember we require the terminal value. And that 2010 free cash flow will occur in 1 year from now. Okay, so this is going to be your year 1, 2, 3, 4. Okay. In order to calculate a terminal value, Pedroia intends to use an Elliott's PE and earnings. He estimates that Elliott's trailing PE ratio at the end of 2013 to be 28 using a linear regression. So guys, if you're using a PE based on 2013, in order to find the price, you need to multiply that with the earnings also of 2013. Correct? That's how you get the terminal value. So they've used the P of 28 from regression, and then they have given us the dividend payout ratio forecast 2013 earning to be 70. So when you multiply that with 70, that's how you get the terminal value. 28 into 70, you will get a terminal value of 1960. Understood, everyone? Clear? All of this you will discount at 12%. So this is going to be your C01, C02, C03, and C04, two values. Go to the cash flow function, use the discounting rate as 12. Let me know what's your answer. Everyone, go ahead. Cash flow, second clear, put C01 as 65, enter. C02, 68, enter. C03, 72, enter. C04, you'll put two values, 75 plus 1960 equal to, enter, down arrow. 12 is your discounting rate and compute NPV. Are you getting 1456.77? 1456.77, which is roughly 1457 million as value of equity. Clear, everyone? So actually it's a free cash flow question only, but just that the terminal value you got it using the multiples. Got it? I expect this type of questions to come in exam because here they're combining both free cash flow and market multiples, multiple model both. Got it? Which of the following is the normalized earnings figure for 2010, which will be calculated using the average return on equity method? Guys, what is normalized earnings? Normalized earnings. When do we use, in what case do we require normalized earnings? Normalized earnings. There are two ways to calculate normalized earnings. Does anyone recollect? Normalized earnings. They want us to calculate using average return on equity. So guys, there are two ways of calculating normalized earnings. When you use average ROE is net income over equity. This equity is nothing but the book value, but this you need to multiply with book value per share if you want to find earnings per share. So normalized earnings per share, if you go using the average ROE which they have asked, You need the average ROE and multiply that with the book value per share. So I require the average ROE. So what all information I have? Which of the following is the normalized earnings which will be calculated using the average ROE? Here we utilize all the information previously. So here is the information which is to include normalized earnings. Okay, this is provided he will use the method of average ROE. Again, same information, right? So we have 27, 8, 9 data, and we have the ROEs provided to us. All we need to do is take the average of this. Let's find the average. 14.8 plus 15.4 plus 18, 48.2 divide by 3. Are you getting 16.07? Clear? Store it, right? Multiply that with the book value per share of the current year, which is 16.4. So 16.07 percentage into 16.4, that's your book value per share. That will give you your answer into 16.4. Everyone is getting the answer 2.63. Yes, very good. Everyone, 2.63. Easy, easy. Our answer is 2.63. Check out in the formula that we wrote, normalized earnings. Normalized earnings, you have two ways. You first of all, we use normalized. These are for adjusting the cyclicality. Either we use using average earnings itself, which is very much simpler, or we take average ROE into the current book value. Got it? Clear? Interesting. Clear, everyone? Next. Which of the following is least likely to be a limitation of the predicted P using the used by Pedroa to calculate the terminal value? We use terminal value using PE based, right? Correct, correct. In his FCFA valuation. Now they are asking which one of the below is least likely a limitation. See, P ratios have limitation is that the P ratios don't capture a lot of information, right? But they have a lot of advantage. They are easy to use, right? First, which one is not the limitation? So let's see one by one. The predictive power of estimated regression for a different time period is uncertain, isn't it? This is correct because we are using regression model, right? And the regression model is not 100% reliable, right? There is uncertainty in it. The relation between the PE and the fundamental variables examined will be static. Do you think in this ratio, the relation will be static? Static? No, actually the relationship keeps on changing. So this relationship is not static, it is dynamic. This is one wrong word. Next, multicollinearity is often a problem in time series regression, such as what Pedro used. Yes, isn't it? Multicollinearity is a problem, isn't it? In any time series. So nothing wrong with this. The only incorrect stuff is P. Clear, everyone? Easy, easy information. Which of the following error has Pedro made in backtesting his stock screen? So we'll have to see what type of error has he made. Okay, all this information is given. He implemented his stock screen system. Okay, before implementing, he backtested it using 2005 year-end ratios published by his favorite analyst journal. Okay, nothing wrong in that. Using those ratios, results showed that if he had bought the stocks at the end of 2005, which passed his screen, he would have made abnormal profits. Now, guys, what is the problem? Whenever you do the backtesting has problems. What are the problems? Here, he's using stocks screen system by implementing, okay, tested in the year and published by his favorite analyst journal in April. So he is using the ratios, okay, but backtested using 2005 year-end ratios, which were published in April. So guys, you are using here, you are using here, you're using a ratio published in April, correct? But the information of, let's say, the price, let's say it's a price to book value ratio. So the price is of the current year, but then you are using an information which is based in April. What type of bias is it? His results are subject to survivorship bias, suffer from multicollinearity, or from look ahead bias. This is something that you might get it from your level one knowledge. Remember, there is one bias like look ahead bias, which has a problem. What is the problem in look ahead bias? For example, for ratios like price to book value, you might use the current price, but the book value is published after a couple of months when the financial statements are finalized. So you use a forward data with the current price. That is where we get a bias which is called look ahead bias. So here the problem is that the data should have been used when it was supposed to be calculated at the end, but instead of using at the end of the year, they are using a data which is published in April. So using the data when published rather than year end is an example of a look ahead bias. Got it? What is survivorship bias? Survivorship bias is when you are ignoring some of the data. That's not the case here, right? Multicollinearity is a problem in a time series analysis. Clear? Now, everyone got it? Now let's go into the second example related to the P. Okay. Berheim's investment bankers have determined the value of the country point to be this. Okay. They've been provided with the value. Clear? As a part of spin-off, Beechwood issued its common shareholders 2 shares in Country Point P for each Beechwood share. So now let me read the question. Beechwood merged with Country Point P Homes, okay, in 2003. Both were running well, but because of tax consideration, they said they need to segment the business between these two. So they are looking for a spin-off. So Beechwood is now planning to have a spin-off because it's a different company, right? So what all information we have they want to do the spin-off valuation. The following information is available. Country Point P's allocated equity was this. Beechwood paid no dividends. Okay. Country Point's free cash flow is provided to us. Risk-free rate and other information I'll require probably for CAPM. Okay. Beechwood Builder has 5 million common shares. So Beechwood had 5 million shares. Country Point's equity was this. Now, they have asked me that each Beechwood shareholder, how many shareholders Beechwood had? Beechwood had 5 million, correct? So they are saying after the spin-off, the spinny company's shareholder is nothing but the spinner, isn't it? So, at what rate are the shares going to be allocated? They said Beechwood issued its common shareholders 2 shares in Country Point for each share in Beechwood. So basically, you will get 2 shares for every share that you held in Beechwood of Country Point P, isn't it? So basically, in Country Point, you will have to issue how many shares? Can I say 10 million? Because let's say each of the Beechwood shareholders will get 2 shares, so there are 5 million. So basically Country Point will have to issue 10 million shares, isn't it? And the value is denoted as 162.6 million. So the approximate initial offer price will be, can I say the offer price is going to be, we are planning to give value of the company is 162.6 and we are planning to issue 10 million shares. So very easy, 16.26. That should be the price, isn't it? Everyone understood? Easy. Next, immediately after spin-off, Country Point's book value per share. See, after spin-off, Country Point will have how many shareholders? Number of shares we discussed, they will have 10 million, right? Clear, right? So this is the number of shares that they will be having, 10 million. Now, in order to find book value per share, I require the book value or total value of equity divided by number of shares which I now have. So let me see what all information they have. The following data for country point is available. Okay. Net income depreciation. Okay. There are three comparables for the country points peer groups. They provided me with the peer group. I require the book value. Country points free cash flow is okay. This is provided to me. Country points cost of capital is equal to ROE. Okay. Did not have any long-term debt. Now, is there any way that I can find the country points book value, everyone? Here, if you notice, country points allocated common equity was 55.6 as on December, just when the split was about to happen, right? But book value is nothing but the total value of equity, isn't it? So we have the common allocated common equity was 55.6. So 55.6 was allocated to country point. That's the value of equity, isn't it? 55.6 million divided by how many shares were allocated? 10. So it has to be 5.56. Easy. This is immediately after spin-off. Future depends on the free cash flow, but at the point of spin-off, this should be the case. We allocated them 55 million equity and we issued 10 million shares. So at that point, the book value should be this. Clear? Assume for this question, after the initial offering, the country points piece share price is 16.26. Based on the initial spin-off offering half of the spin-off, the estimated price to book value ratio. Now, guys, now I already have the price being provided to me and the book value from the previous case. So price to book value per share, I have been given the price 16.26. Book value, I got it from the previous point. So 16.26 divided by 5.56, you will get 2.92. That's your price to book value ratio. Simple, based on the information before. Clear? Next, based on careful analysis, the firms comparable to the country point trade at a price to book value. This is what the comparable company's price to book value ratio is. The expected price per share after spin-off based on this ratio, assuming a liquid and efficient market. So in order to find estimated share price, now how do I find share price using the price to book value ratio? Guys, we have the industry price to book value per share. Multiply that with the book value per share that currently the company has. That will give you the price. So they've provided us the average. They have already given us. We will utilize that 3.5 into the book value per share that we already have. That should be the price. So 5.56 into 3.5, 19.46. Understood? Everyone clear? Right? How we are utilizing price to book value information? Check, check, check. Perfect. Now, let's go to residual income valuation. Residual income, here getting the information of residual income is critical. Otherwise, the process is perhaps the same, right? So let me take you down to the formulas of residual income that we did, everyone. Our residual income formula, right? Where we have earnings minus the book value into the cost of equity. So that is our equity charge. Clear? This is our equity charge. Got it? Everyone? So residual income valuation, very important. But as I said, there is a high chance in exam, they might probably blend multiple things together. Got it? So let's do that. Now, first thing they've asked me, calculate traditional measure of return on equity based on opening. Very easy. Normally, how do you find return on equity is net income over equity, but they are saying use the beginning equity. So for this reason, I need net income and beginning equity value. So here's the information. You are the chairperson of this company. You are reviewing the information. 2004, 5, and 6. Everything is in $1 million. I require return on equity. So I require net income and total equity. Clear? So my net income of the most recent year is 12.5, and total equity for that I go to the balance sheet, but I need to look at the beginning. So I will go for which year's equity value, everyone. Where is my equity valuation, guys? I will go for 2015, right? Because they told me to use beginning. So I will go for this particular year's equity value. Common stock, additional and retained. This is my total equity. So let's take these three information, 30 and 55.2. That is 85.2. So 12.5 divided by 85.2. Why? Because they asked me to use the beginning value. Otherwise, when we have both the years, we can take the average. So normally we take the average. So 12.5 divided by 85.2, I will get 14.67. Clear? This is important. Okay, clear? Next, calculate RETI's EVA based on the year-end invested capital. They've clarified it, everyone. And let me also tell you, they have asked for residual income also. They've asked you for the market value added. So basically everything you have to, that you've done in residual income, we have to calculate for all. We have to calculate EVA, MVA, and residual income. For EVA and MVA, let me ask you all, what is the formula? Economic value added, market value added. Economic value added is based on, yes, NOPAT, net operating profit after tax, that is EBIT 1 minus T, minus, see, EVA is for the whole firm, right? So minus, you're going to use total invested capital on which you have to earn the WACC. Total invested capital is debt plus equity or total fixed assets and working capital. You can use either of the way. Okay. So you can use either total invested capital, either you can use debt plus equity, or you can take total assets, fixed and working capital, total assets. Both are possible. Okay. For market value added, market value, I require the market cap of the company minus the company's value based on the book value. So minus the total equity value based on book value. And that's how I will get how much is the value addition in the company. Okay. So we will calculate both now. First this. So EBIT 1 minus T, 2006. 2006 EBIT, interest before tax, right? And the tax rate. How do I find the tax rate? Have they provided me the tax rate? That is 45% directly is provided to me. So 28.1 minus 45%. So 28.1 into 0.55. My NOPAT is 15.455. This is EBIT 1 minus T. NOPAT is what? EBIT 1 minus T. Correct? This I will store it. Now I need to find WACC and total invested capital. What is my WACC? My WACC, they've told me, is 12.5. Clear? 12.5. Beta, okay, equity holders return, fine. Total capital. I need total of debt and total of equity. Now they've given me equity, but I don't have the total debt information. Maybe there is no debt. I don't know all the liabilities, whether they are debt or not. So you can also use the other option. The other option is finding the total assets. How do I find the total assets, guys? Total asset for the current year. Remember now, you're looking for the current year information. So since you are in 2016, you will look at 2016, you have the total assets. You can use 2016 total assets. Everyone, right? So on 110.5, you require 12.5. So 110.5, on that you require 12.5 percentage. So this is store one. 110.5 into 0.125, that is 13.81 minus this, you will get 1.6425. That is roughly 1.6 million. And of course, it is positive. Are you getting this, everyone? Clear? See, guys, I didn't have total debt and equity. So what I use the alternate total asset also you can use, because total invested capital, debt or equity is your capital that you raised, sources of funds. Investment is total assets. Clear? Sometimes they also give you fixed and working capital. That is also your total assets. Got it? Now, before I do residual income, I will do market value added. Market value added is market cap of this company. For market cap, they've provided with me to me market value of the company 146. But this is just the market value of equity, right? I need to check if there is a debt. Debts required return is 5%. Is there a debt related information note is given to me, admin expenses? Okay, goodwill is fully written off. 8 million debt was repaid. Okay. Other than the debt redeemed, the liabilities consist mostly of long-term debt valued at approximately book value. So in the liabilities out of 16, okay, they are saying 16 is the most of the value is related to, most of this value is related to debt, isn't it? Correct? 8 million debt was repaid at the start of 26, and at the start. After that, also the liability at the end is 16. So can I say 16 is the total debt amount? Isn't it? So when I now look at the market value, how much is the addition in the market value? What is my market value MVA formula? See here, MVA is market value of long-term debt and equity. You need to only look at long-term debt and equity, and same with the book value. So I have market value of long-term debt and equity. Everyone, long-term debt and equity. Yes. What is my long-term debt and equity? My long-term debt in liabilities and equity is this, isn't it? But this is book value. We require market value. So for book value, we don't know for market value of debt, we don't know whether there is a difference or not. So they have not provided whether the book value and market value are different. If not, we assume both are same. But for market value of equity, I have 145. So I have 145 as the market value of equity plus 16, entire 16 they are saying is like debt. So 145 plus 16. This is the market cap of debt and equity, right? And the total equity plus debt. So basically it's total capital. So here we require book value of invested capital. So total equity plus, I forgot to mention, total capital or total equity plus debt. Okay, this is based on book value. So now I have equity plus debt book value. Debt is to be same, but what is the equities book value? 20 plus 30 plus 10, 30 and 64.5. That is 94.5. This is going to be 94.5. And since, of course, the debt value is the same. Okay. So basically you'll do 145 minus 94.5. You can ignore 16. That is 50.4 roughly. Correct? Are you getting this answer? 94.5 plus 16 and 145, everyone. So it should be 5, right? Sorry. 50.5. Clear, everyone? Why debt is not 8 as per market? No. Okay. Very interesting thing. The question is why debt is not 8 million. See, 8 million was repaid. After repayment, what is the debt remaining? The debt is still 16. So 24 was in 25. Out of that, 8 was repaid. So the balance is 16. Understood? Why debt is not 8 as per market? Debt 8 million was repaid. Clear? So after that, what remains is 16. Got it? Now, in order to find residual income, Let me know the formula of residual income. You can find out residual income using the earnings per share if they give you, right? Or you can take the difference of ROE minus the cost of equity into the book value. In both the case, you will require the book value. But if you have earnings, you will take the earnings per share and minus the charge. The charge is basically your return on the book value, correct? Right? So let us see what we have here. We have the earnings. Do we have the earnings? Earnings. Equity shareholders return is provided to me 15%. Correct? I need in this case two things now. Is the earnings, right? For me, the earnings is net income. Correct? Now I need to see whether they've given me everything in per share or total. So if they've given me in per share, no, they've given me everything in total, right? So we can also take the full value. So here we can take 12.5 as the total earnings. So 12.5 minus, we need to earn how much? Cost of equity is also 12.5 percentage, 12.5 percentage on the book value. Remember, for book value, what are we supposed to do? What is the book value that I'm supposed to take? Book value at the beginning. Yes. Currently, the book value that I've invested, that is the beginning book value. If you notice, this is the beginning book value. So in this case, important it is which book value should I take? I will take the 25 book value, which we had already calculated 85.2. Got it, everyone? So this will be into 85.2 book value at the beginning. Correct. Let's find this. So 12.5 percentage on 85.2. This is what I need to earn minimum. Minus 12.5, you will get 1.8. Sorry, 12.5 percentage on 85.2. Is it 12.5? Oh no, my mistake. I'm so sorry. I think I took WACC. We should take cost of equity. So sorry, so sorry. We should take cost of equity, 15 percentage. Sorry, this has to be 15 percentage. So this is going to be 15 percentage because we are looking for equity, right? So here 15 percentage on 85.2 minus 12.5. Everyone, are you getting minus 0.28? Minus 0.28, which is negative 0.3 million. Everyone, correct? Residual income is negative. Yes. Okay. Here our market cap was 50.5. And now the last one. The chairman has drawn a budgetary forecast suggests that the residual income will be 5 million for the year ahead, next year. Management plans for medium term lead you believe that they will increase by 5% per annum for the foreseeable future, that is perpetual. Using the residual income method, value equity, that is equity as of December. Now, guys, in order to value, right, using the residual income approach, how do we value the company? For valuing the company, guys, we have the current value based on using the residual income. What is the first starting point? The book value. Very good. Plus the present value of the residual income. Here, the present value of the future residual income. Book value, I have the book value, current book value I will take for the forecasted 2007. So I will take the 2006 book value, which is this 30 and 64.5, that is 94.5. So 94.5 is going to be my current book value. Correct? Plus present value of future residual income. They said that the forecasted residual income is 5 million, that is D1 over R minus G. That is cost of equity minus growth rate. Growth rate is 5 percentage. Now, cost of equity. What is my cost of equity? It is 15 percentage, right? So 15 minus 5 is 10 percentage. This is going to be 50. So this has to be 144.5. Are you getting this? Easy, easy, easy. Clear? Why did I use this? Because perpetual. They said Gordon's growth, constant growth. They haven't given you multi-stage information or anything as such. Clear? Everyone? Understood? Perfect. Okay. Now we go to the last topic, private company valuation. Now, this topic has mostly theoretical things. Okay. However, some of the practical questions are also being put up here. So, Jimmy Choo works for Joel Constable. Okay, fine. All this information is there. Constable is a private company. Of course, since I know this is a private company information, otherwise you will have to read in actual exam and understand what type of company it is, right? But as I always say, it's better you can directly go to the questions and start seeing if these case studies are too lengthy. Okay. Now, many students say, sir, how will I solve so much of information? Actually, you can go step by step and you are actually going to complete 4 or 5 questions together. So it is time consuming, yes, but you also have enough time. However, you have to catch up with the speed from the beginning. Okay. Assuming Chu uses price multiples based on 4 years of financial information from Bakan. So 4 years financial information from this company, Bakan. Okay, Bakan Fashion, 4 years information I have. Fine. There is a company. Okay, we have 4 years of information. Fine. And we are going to use which one? It is going to use price multiples, maybe P ratio or some other ratio, right? Ignoring his additional notes regarding 2010, they have asked us, okay, don't worry, ignore this 2010. So thank God, we are going to ignore this. Which of the following statement is least accurate? Now, when they say something like that, you'll have to check one by one first the statement and verify from the, from the exhibit that they've given. P ratio would be meaningless. Let me see. P ratio would be meaningless. Yes or no? PE ratio, companies, revenue, net income is negative, isn't it? When the net income is negative, guys, does doing PE ratio make sense? Out of 4, 3 year is negative, isn't it? So can I say the first statement is correct, isn't it? You're looking for the wrong statement. So since my earnings are negative, this is a true statement. This is remember, you're looking for a wrong statement. Price to book value ratio would be the most useful as they would take into account of the human capital in a startup business. Guys, do we take human capital in the price to book value? Do we do such things? No, no, no. So price to book value, this is incorrect information. Let's see C is correct or not. Price to cash flow ratios are theoretically better if calculated using free cash flow rather than CFO. Guys, in the price to cash flow ratios, free cash flow is considered better than the CFO. Understood? So that's not wrong statement. The wrong statement is B here. Clear? Perfect. Next, when valuing private companies, how would the factors described by Chu usually be classified? Factor, they've provided us with factor. Okay. So these are the factor 1, 2, 3. Now they are asking how the factor would be classified. Factor 1, sector stock specific. Factor 2 also stock specific. 1, 2. Actually, if you notice, they are only asking for the 2 factors as per the choices. So you will also focus on the 2 factors. Understood? Not the third factor. So you have to look at stock specific and company specific. Stock specific factors are related to the trading or liquidity. Company specific factors are related to the company's business model. Okay. So we have to identify whether factor 1 and factor 2 are which type of, factors. Okay. So let's say first, private company equity typically has fewer potential owners and is less liquid than publicly shares. This is stock specific factor, isn't it? Liquidity is related to the stock. One key objective of the board of Bakan may be to limit exposure to taxes as 75% of the board members also own substantial. This is about the company's corporate governance. So this is company specific factor. Of course, you don't require third one, but let's do it. Due to significant ownership of equity by the board, management may be tempted to take short-term view. This is also company specific. Anything which affects the stock prices, liquidity, that is related to stock factors. Understood? So only first one is a stock specific factor, and second one is a company specific. So my answer will be factor one is stock specific, factor two is not. Clear, everyone? B. Why is B the answer? Is Chu correct in his assessment of factor three? The answer is yes, no. It's rare for private companies to allow key management to own equity. No. In private companies, management can have equity, right? Correct. So what they are saying is incorrect. Rare. No, board equity ownership usually results in long-term view than public companies. Equity ownership usually results in long-term views, everyone. So we are looking for which one is his correct assessment. Is factor three's assessment correct? Let us see. Uh, do, 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 do. Factor three. Due to significant ownership of equity by the board, okay, which is common in private companies, Bakan management may be tempted to take a shorter term view. No, they would rather take a long term view, right? In private companies, when you have more ownership, you take a long term view. You don't have to be answerable to the shareholders every year for dividend and all. So factor three is correct. No, it is incorrect. Rather, they take a long term view. So C is the answer. Am I correct? Right? The two company comparison method of valuing a private company is consistent with approach. So they are using comparison method, comparable company approach, right? Income approach, multiple approach, market approach. Let's see what information they provided about us for this. Constable always prefers to see a basic analysis of price multiples, okay, before any valuation. Chu produces this where possible, but usually follows with the valuation of the private company using price multiples based on the recent sales. He calls it as Chu comparison method. So guys, he is using price multiples. Is that an income approach, multiple or market approach? Very easy. He's using price earnings model. So it's a multiple approach or a market approach, everyone. Check, 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 check. What type of approach it is? Multiple or market approach? Yes. Why market approach? See, multiple approach is where we use, yes, multiple approach, P multiple, earnings and sales approach, right? These are the approaches that we use. Here they are asking us that in the case that the company is consisting with which major approach, income approach, multiple approach. First of all, income approach is the discounting cash flow approach, right? What about what about the multiple approach or a multiple approach? We know price earnings. What is market approach? What is the difference between multiple and market approach? Anyone? Multiple and market approach. Is there a difference between both? Multiple and a market approach. Anyone, any guesses? Because sometimes they use this information which confuses many students. What is a multiple and what is a market approach? Any difference that you guess between these two? Minor difference between the both. Multiple is price multiple, right? The three major approaches that we have is income approach, which is present value of the future income, right? Multiple and market approach. Now, see this very interesting. They have actually twisted all this thing. So, see, I will take you to the information here in private company. Market approach is the guideline public company method, guideline transaction method, everyone, and prior transaction method. What are these called as? These are called as market approach. Do you see that, everyone? For private companies, here you use income approach, and second is market approach, under which you have different valuations. Got it? Here, when you use another company's price earnings, so then you will have to lever and lever. You cannot directly use another company's price earnings. Are you getting my point? You cannot use it. Why? Because our companies are not listed. So instead of multiple approach is the term that we used for public companies. For private companies, the approach's name is market approach. Are you getting my point? These three approaches, they are called market approach. Clear? Not multiple approach. They are called market approach. Within that, there are several approaches. Are you getting my point? Where is that the difference, right? So out of the three approaches, one is asset-based valuation approach, asset-based approach, NAV-based approach, income approach, and for private equity, equity, it is not multiple approach. It is called market approach. Understood the header? Clear? Right? Yes. Is Constable right in his suggested renaming of the final valuation? What is he trying to rename? CCM valuation is then adjusted by Constable, and Chu takes into account of Constable's individual financing cost and any pursued synergies with existing assets. Chu refers to this final valuation after adjustment in his report as intrinsic value. Is he correct about this or not? Correct? See, what is here? What is this valuation? He uses this term called as investment value, right? But Constable has recently taken him to the task on this and suggested that the valuation focuses on the value to him as a specific investor. It should be recalled as investment value. Now see these two statements. They are basically talking about the definition. Okay. So when he's adjusting the valuation, okay, based on the financing cost, perceived synergies, Chu refers to the final valuation after adjustment as intrinsic value. Right? Now, the question is Constable right in his suggested renaming of the final valuation? Everyone, renaming of the final valuation that you have. In this case, what are the final valuation options I have? They have provided me this information where they have said, has recently taken the valuation focus on, okay, specific investor. As an investor, yes, you call it as investment value, correct? But here the question is that, is he right in his valuation approach? Answer is either yes, no, a valuation based on analysis of companies fundamental should be referred as intrinsic value, everyone, or it should be renamed market value as it is as it uses primary information. Sounds so confusing. Is Constable right in his suggested renaming of the final valuation? See, what name did he prefer? Intrinsic value. Is he right or wrong? He's adjusting the information and then trying to use it as an intrinsic value. Is he correct or not? First of all, that is the question. Why is he right or wrong? See, what is the difference between investment value and intrinsic value? Your investment value is from the point of view when you're going to buy that company, correct? So here, is he planning to take over the company? So to usually task with a constable as and if I may proceed. Okay, most of the opportunities, okay, with little history. Some are okay. Back in fashion, company began. Okay, who invests a large portion of his portfolio in order to chase high returns. Okay. So he's looking out for opportunities where he's going to invest. So since he's going to invest, calling it as an investment value or intrinsic value, what is the difference in both? Investment value or intrinsic value, everyone. So the question says that is constable right? CCM valuation is then adjusted by constable and Chu to take account of constable's individual financing and any pursuit synergies. Chu is calling it as intrinsic value. Constable, this guy is suggesting it as investment value. Yes, when you're going to take over a stake in the company, when you're going to be the buyer of the company, Constable is saying that you should rather call it as investment value. So Constable is right because he is going to take over the company. So Constable's view of calling it as investment value is correct. Understood, everyone? But when you're going to take a minority stake, you find P0, that's called intrinsic value. Right here you're going to take over the company, so his view of calling it as investment value is correct. Why? Because investment value focuses on what should be the value of the company for the buyer. Clear? Very tricky. Next, using choose additional notes on Bakan's 2010 net income, which of the following is most accurate estimate of normalized earnings? So we have to use 2010's net income information. So go CEOs, yes. So here, what is normalized earnings? Here we might have to we might have to adjust few things. So in the normalized earnings, just let me inform you in case of normalized earnings, what are the adjustments we do? Here we adjust for any additional things which is not supposed to be there. So normalized earning is adjustments for, if you see on the screen, for non-recurring or unusual items. These are items which are discretionary and tax motivated. Why? Because in private companies there are many adjustments that you do. You raise the compensation, or you use your own premises, or all of these things you use to reduce your tax burden. Correct? So in private companies, normalized earning means adjustment for these two types of adjustment: discretionary and tax motivated earnings. So we will check out if there is any adjustment related to that. Okay. So here, net income. What is my net income, guys? What was my net income? Net income, do I have my 2010 net income is 0.1 million. Everything is in million. So 0.1 is 100,000. So my net income is 0.1 million is 100,000. CEO's compensation package is 650,000. This is where it can be either exaggerated or lowered, right? So anything related to CEO's compensation, then CEO, okay, discounted CEO agreed to the compensation package and paid, okay. Two estimates that the market-based compensation was 850,000. But somehow this guy convinced him to work at lower. So what is the market-based compensation? 850. So guys, 650 is not accurate, right? There will be 850. So this will reduce my net income by the difference of 200,000, isn't it? 650 minus 850, 200,000. By this amount, my net income will reduce. Clear? Next, leading fashion supplier provided the retail outlet at a rate of 120,000 per annum for the first 4 years. CEO helped. Okay. Yes. A friend of the CEO that helped up the outline operation for a discounted cost of 20,000. Everyone. Correct? Okay. Two estimates. Okay. The market lease rate for the retail unit is 170. So guys, you paid 50,000 less, right? If it was not a private company, you would have paid 50,000 more. So I will deduct that as well. And what about the setup cost? Should I adjust for this 20,000 also? They said that the setup cost for the line operation should have been 50,000. Everyone, setup cost should have been 50,000. Now, only those costs which are related to discretionary and tax purposes, those we need to adjust, right? So first of all, here we are going to adjust for which all costs. One cost we are going to adjust is for compensation, correct? The extra lease cost we are going to adjust, right? Because both of these are going to be recurring, correct? One time cost. What about the setup cost? Setup cost generally is a one-time cost which we do not adjust. Once one one one-time costs are not relevant for the future because they are like a sunk cost. So why am I not going to adjust the setup cost? Because it's a sunk cost. What is going to be recurring in the future, that I will adjust. So that adjustment is this. So 100,000 minus 200 is minus 100,000 minus 50. So my normalized earning should be actually minus 150,000 minus 100 minus 200 minus 50. So plus 100 and this is going to be minus 150,000. Remember here, we are not adjusting for setup cost because it's like a one-time sunk cost. We are looking for estimated normalized earnings. So in the future, there is not going to be differences in setup cost. Understood? Clear? Setup cost is one time, past, done. Very, very important. Clear? Now, these all varieties of equity related questions. This is what I've highlighted. I suggest you practice this more than enough. Got it? Everyone? Right? We've covered all the topics, all the varieties possible. Okay? Right? Okay. Thank you.